What's relevant is the macro situation for gold. Is gold going to $7,000? So my $5 target isn't that crazy talk. Now that's a $200 silver, but that's my target. I think we're going back down to at least 4,300, maybe even lower. And so I'm waiting for that correction for my next buy. What people don't realize is this economy had a problem before the war. The economic problems, they didn't arise because of this war. They were already there, and they haven't gone away. Right now, the insurance companies and the pension funds and Wall Street is like, hey, we're making 20% a year buying the Mag 7. Gold at an all-time high, S&P at all-time high. That shouldn't happen. Gold and the economy are supposed to be opposites. Who's going to win? Inflation is high, and it's not going down. Interest rates are high, and they're not going down. Gasoline is high, and it's not going down. So we're betting on gold prices going higher. And we're making some assumptions. We're making assumptions we're not going to have hyperinflation. We're making assumptions we're not going to have these massive taxes, royalty taxes, et cetera, where they get brutalized. And we are going to get rug pulled in certain ways. So I have about 165 stocks. Eric Sprott has a few more than me, but I haven't found enough 10 baggers, but I don't think I'll catch up to him. But he's not that far ahead, 175, something like that.
His positions are just a little bigger.
Yeah, a little bit bigger. But the quantity of stocks, we're kind of in the same ballpark. We like to own everything. If you own everything and the market is huge, you go up bigly. And that's what we're after. We're after big alpha. And that's why we're simpatico. We're both chasing alpha because we believe alpha's there to be had. I'll give you one example. I bought a vino at 50 cents. And I told everybody, I said, look, this is probably the best stock out there. Buy it to the bottom. It got down to about 43. That was about as low as it got. Today it's about $7. My target is $5 for a vino. They have 300. Today they came out with a resource of 387 million ounces of silver equivalent. They're only producing 2.5. So that tells you the growth they have, right? And they have organic growth to get to 9 million ounces. So my $5 target isn't that crazy talk. Now that's a $200 silver, but that's my target. But if it gets to $5, if you do the math, that's a 250 bagger. If it goes to $1, it's like, I think $50. It's 10 bagger. It was already a 10 bagger.
Owning everything can sound reckless until you realize some investors are quietly treating diversification as a way to capture one rare winner. As Don Durrett points out here, the real message is not the number of holdings, but the willingness to sit through volatility before the market recognizes underlying resource value. A company moving from 2.5 million ounces toward 89 million in output can change valuation faster than most analysts model. What often gets missed is that patience, not prediction, usually creates the outsized return. Next, Don Durrett discusses why finding a single true outlier can outweigh dozens of average positions.
My math in my head, it gets crazy, but it's 250 bagger. I guess it's a 50 bagger if it gets to $1. So 250 bagger. I mean, that's the kind of leverage that you get in these miners. Now, so 20 baggers, believe it or not, are going to be somewhat the norm. So I'm looking for 10 baggers, but if you find a 10 bagger and it doubles, that's all it has to do. You have a 10 bagger, it goes up 1x, it's a 20 bagger. If you find a 5 bagger and at 1x, you got a 10 bagger. So find five baggers and 10 baggers, and you're going to find 20 baggers. This is going to happen. I mean, in the mining sector, it's not a 1 bagger is nothing. So if you find a 10 bagger, you probably found a 20 bagger, which is kind of crazy talk, right? It's kind of crazy talk. So I've been doing this for 20 years. And it's always been crazy talk. But now we're in a bull market, it's not so crazy talk anymore, right?
Yeah.
A 1 bagger's can happen overnight.
So, Don, let me kind of direct you to the current situation we're in. Well, we got off to a hot start, obviously, in January, and then recovered beautifully in February. Man, I signed off. I remember, I'll never forget it. February 27th, we printed the monthly charts and everything went great. And then I wake up Saturday the 28th. It's like, uh-oh. I would imagine you probably see this the way I do, but I'm going to let you answer the question. I mean, we've gone now, this higher energy cost is somehow driving fears of inflation and interest rate hikes. when to me, it's more of a higher energy costs are going to slow the economy and lead to interest rate cuts. Do you think the market's getting it wrong? Am I getting it wrong?
Well, yeah, let me explain. So the bull market, I believe, in the gold and silver miners started in August. In August, the beginning of August, silver's at $35. You weren't in the market yet. And then we ripped. By the end of August, we were off and running. We got above $40 off and running. We were in a bull market. But the bull market wasn't, it was just like this first surge, right, to October. Almost about a 2-month surge. And then you had a correction. And that correction lasted about 4 weeks. Then we had another big rip after that, in December, in January, and then we had another correction. And then we almost retraced back, but gold's down 17%, silver's down over 50 to get to the top. For gold to get back to its all-time high, 17%, silver 50.
Big upside stories usually make investors ignore the part where volatility can erase confidence before wealth ever appears. As Don Durrett points out here, mining leverage works both ways because a 17% drop in gold can create far deeper damage in smaller producers. Rising energy costs are also changing how traders interpret inflation and rate expectations at the same time. What sounds like optimism in a bull market can still hide fragile sentiment underneath those price swings. Next, Don Durrett talks about why these violent pullbacks may still fit inside a much larger long-term trend.
But these corrections are normal. That's what you expect in bull markets. But you always get higher highs. I lived through the last bull market, and we had a lot. Every year we had corrections. But you have a higher low and a higher high. You just keep rolling back up. We went from $250 to $1,935, basically 8x. And this one here, I think we're going to do the exact same thing. I think $7,000-8,000 is kind of where we're going. So it's just a little correction. Now, the one thing about where we're at right now as I speak, I've been saying this bull market really hasn't hit its stride yet. So we're still in this period where there's minor stocks are still cheap. The sentiment hasn't improved yet. So I've been doing this for 20 years, so I kind of get the feel for it. I mean, if you look at the free cash flow multiples of the high quality names, they're very low. So we really don't have a strong sentiment, and you have to understand why. So we're early innings in this bull market, and we haven't hit our stride yet. We really don't have the wind at our back yet. You have to ask yourself why. And I've been trying to tell people, you need certain factors before the bull market really kicks into gear.
Sometimes the market looks expensive only because investors forget how early a cycle can still be. As Don Durrett points out here, the last major gold move ran from $250 to $1,935, and that history shapes how he sees current pricing. Low free cash flow multiples often reveal institutions still have not fully committed capital to the sector. That matters because sentiment usually changes after prices move higher, not before they do. Next, Don Durrett unravels what specific shift could finally push this bull market into a stronger phase.
And once it kicks into gear, then you have to start thinking about the top when it gets frothy. But it's not going to get frothy until it kicks into gear. Now, how does it kick into gear? When is the bull market and miners really working? Well, it's very simple to understand. All you have to do is go back to 1999, 2000, 2001. So gold was dead, right? And the stock market was ripping. And then the stock market died in January of 2000. You had the dot-com bubble burst. Then you had 9/11 in 2001. Gold was at $250. What happened for the next 7 years? Stock market was flat. Gold and silver went up. The miners ripped. So that's what we're waiting for. That's when you get your stride. That's when sentiment improves. And the reason why is because people are like, I got to make some money. Where do I make money at? For instance, the insurance companies and the pension funds, they got to pay out every month. They got to pay stuff out. They got to make money, right? It's like they can't just sit there and make no money. They'll go broke, right? They got to make money. So they're like, okay, what's working? Well, the miners are working. Okay, let's buy some of those. This investment companies and pension funds, those are big institutions. So they jump on board.
The real turning point often begins when large money managers stop trusting the old winners. As Don Durrett points out here, The 2000 to 2007 period showed how capital can rotate once equities stall and defensive assets begin outperforming. Pension funds and insurers do not chase narratives because they need steady returns to meet obligations every month. When those institutions finally notice miners, the repricing can happen much faster than retail investors expect. Next, Don Durrett discusses why that institutional shift could become the signal many investors have been waiting for.
So they buy the majors and it funnels down to the mid-tiers and the explorers. That's how it works. Right now, the insurance companies and the pension funds and Wall Street is like, hey, we're making 20% a year buying the Mag 7. We don't need no gold miners.
Right.
So that's what we're waiting for. That, and I call it the battle, the final battle. So the battle is between the S&P 500 and gold. Now, isn't it fascinating that they're basically since February 2024, they've basically been fighting it out, right? Gold at an all-time high, S&P at an all-time high. That shouldn't happen. It shouldn't happen. Gold and the economy are supposed to be opposites. One's supposed to be working, right? It's either the economy is a problem, I want gold. The economy's good, I don't want gold. One or the other. From 1982 to 2000, gold was totally in the toilet. Why? Because the economy was growing. That's how it's supposed to work. And when the economy, and so what the hell's going on here? So this is the final battle, the last man standing. Who's going to win, right? Every time you have a correction in gold over the last 2 years, every single time, if the stock market went up, gold said, oh, okay, here I come. I'm still fighting. I'm Rocky, man. You can knock me on my butt, but I'm coming back. Here I come. Every single time, the gold is just ripped to a new all-time high. And it's going to do it again. So what we're waiting for here, we're waiting for that final battle to end. And where it's gonna happen is you're gonna have a death cross where the S&P is going down and gold's going up. And the death cross, I think, is going to be right around 5,500 on the S&P. So the S&P goes below 5,500, gold goes above it. That's the death cross. And the S&P and gold, once they crisscross, is like, here we go. That's when sentiment flips. That's when we got the winner back. And ironically, that's when I can't buy any more miners, because at that point, everything's going to be pricey. No more 10 baggers to be found. So right. I think that I really believe that's going to happen this year. I thought it was going to be a second half story. It could still happen here in April if this war doesn't get resolved and the Iranians get a little aggressive and belligerent. They do that. Oil prices spike to 130. It could happen now, but yeah. I don't know. We don't know what's going to happen with this war. But the thing is I've been saying is that what people don't realize, me and you do, we do.
When gold rises alongside stocks, it can signal the market is quietly pricing in two very different futures at once. As Don Durrett points out here, that unusual overlap has been building since early 2024, instead of resolving the way historical cycles normally do. Wall Street still favors mega-cap momentum, because those returns feel easier to defend in the short term. But if the S&P loses leadership near $5,500, while gold keeps climbing, institutional money could move fast. Next, Don Durrett talks about why that crossover may change sentiment across the entire mining sector.
What people don't realize is this economy had a problem before the war. The economic problems, they didn't arise because of this war. They are already there, and they haven't gone away. I heard a guy make a really, really good argument, and I definitely, and I'm like, I didn't really think of it that way. And basically what he said is that inflation is high and it's not going down. Interest rates are high and they're not going down. Gasoline is high and it's not going down. And so if you think everything's going to be rosy over the next 2 to 3 months, like stock market's an all-time high, it's got those three problems to deal with for the next couple of months. Right? Because I don't think that oil is really going to just slip back down to below 80 very easily and gasoline prices drop. So we got high gasoline prices for another couple months, high interest rates maybe for the rest of the year, right? Inflation probably for the rest of the year. So we got headwinds here. I personally think we're going to get a significant correction in gold and silver soon. I don't know if it's going to happen in April, May, June, but right now we're about 47.50.
The market keeps blaming new headlines for problems that were already building underneath the surface months ago. As Don Durrett points out here, inflation, elevated rates, and stubborn energy prices were pressuring consumers long before geopolitical fear entered the conversation. Investors often miss that the stock market can stay near highs even while household purchasing power keeps deteriorating. Oil staying above $80 can quietly strain transportation, manufacturing, and margins across multiple sectors. That disconnect matters more than daily headlines. Next, Don Durrett discusses why that pressure could trigger a deeper metals correction before the larger trend resumes.
I think we're going back down to at least 4,300, maybe even lower. And so I'm waiting for that correction for my next buy.
So that kind of leads me into what's been going on with the shares, because, like I said, at the end of February, GDX made all-time high on the last day of the month. Looked great. The hammer that's been used on them over the last 6-7 weeks is this compressing margins. You know, their all-in sustaining costs of the producers going up because of higher energy prices, while the top line, what they can sell the metal at, is coming down. Is that overdone? Is that anticipating more metal weakness like what you're forecasting, Don? What do you think?
So I'm a speculator. So from my perspective, that's just noise. The one thing as a speculator, I want to get to the top of the mountain. I don't care about 2026. I really don't. I'm not going to sell any stocks in 2026. I'm not after a one bagger. I want big alpha. I want to get to the top of the mountain. So what the current margins are today, what the profitability of Newmont is today, in many respects to me is irrelevant.
Short-term margin pressure can scare investors out of positions that were never meant to be judged quarter by quarter. As Don Durrett points out here, many traders are focusing on rising costs while missing the bigger cycle that often drives minor valuations later. A move from 4,750 down toward 4,300 could look painful on paper, but corrections often reset sentiment before stronger advances. The market tends to punish miners early because institutions still trade them like businesses, not leverage. Next, Don Durrett talks about why the long-term macro view matters more than temporary earnings pressure.
Yeah. Okay.
What's relevant is the macro situation for gold. Is gold going to $7,000? That's what's important. And getting way ahead of it. Like Druckenmiller always says, don't focus on now, focus on what's going to happen. And so what's going to happen is we're going to get to the top of the mountain. When we get to the top of the mountain, you're going to want it. For instance, my target price for Newmont is $500. It's currently trading under 120. Now your eyes are popping out, but I can show you the math.
No, I'm sure.
If you look at their multiple right now, it's 10, and they're mining 5.6 million ounces. So if you go to 7,000, even if their ASIC is $2,000, do the math on the free cash flow and put a 25 multiple on it. What do you get? $500.
There you go.
So it's just math. And so if Newmont's going to $500, who cares about what's happening in Q1 2026, right?
Yeah, that's the right way to look at it.
The only thing you care about is that Newmont is mining 5.6 million ounces when they get to the top of the mountain, and that their costs are not $4,000. And I don't think they will be.
Valuation sounds outrageous only when most investors refuse to run the numbers all the way through. As Don Durrett points out here, a company producing 5.6 million ounces can look dramatically different if gold reaches 7,000 instead of staying near current levels. Wall Street usually discounts these scenarios because forward estimates rarely stretch beyond the next quarter. That keeps many investors anchored to today's price instead of future cash flow potential. Sometimes the market dismisses math simply because it feels uncomfortable. Next, Don Durrett unravels the assumptions that could either support or completely break that projection.
So we're betting on gold prices going higher, and we're making some assumptions. We're making assumptions we're not going to have hyperinflation. We're making assumptions we're not going to have these massive taxes, royalty taxes, et cetera, where they get brutalized. And we are going to get rug pulled in certain ways. But if we get to the top of the mountain and we own Newmont. Now, I was telling everybody to buy Newmont at $30. I said, look, I'm a buy to the bottom, sell to the top guy. When I see a bottom, I let people know, hey, everybody, Newmont's at the bottom. It's buy to the bottom. We're there, right? $30. It never got to 29. It had a 29 handle, but it never got below 29. 29.50, 29.70, something. But at $30, I said, that's the bottom, people. You see it? You see it? Okay, so Newmont, if you would have bought Newmont at 30, it was a 10-bagger all day long, there's my 10-baggers, right? Yeah. Now, I didn't buy Newmont because I own 3 mutual funds, and Newmont is one of the biggest positions in all 3, and I own 6 or 7 mutual funds. ETFs, and it's one of the largest positions in all of those.
Every big projection depends on assumptions that rarely get discussed when excitement takes over. As Don Durrett points out here, even a strong gold thesis can be damaged by taxes, political policy, or cost inflation that investors cannot control. Buying near 30 and seeing a path to a tenfold return sounds simple after the fact. The harder part is recognizing that even strong miners still carry jurisdiction and policy risk beneath the surface. Responsible investing means weighing both upside and fragility. Next, Don Durrett discusses why portfolio positioning can matter as much as stock selection itself.
Well, not the silver ones, but the gold ones. So I had enough in Newmont already. I didn't buy it. But if I didn't own ETFs or mutual funds, I would have been buying it for sure. It was a 10-bagger. And so now, but Wall Street, they want 20% returns. They're like, you give me 20%, I'm happy, right? In Wall Street. You give me 25, I'm really happy, right? Newmont is going to go from 120, or where it's at today, to 500. At a certain point, they're like, man, I can get my 20% pretty damn easy if I buy some Newmont.
Yeah, you think I'd figure that out.
So when Newmont gets to 150, 175, 200, somewhere in there, people are going to start buying it. And the multiple is going to go up. I think a 25 multiple is conservative for where it's currently at 10. So you're buying it for less than half off right now. And that's just one example. And and that's one of the leaders, right? And it's one after another after another. This isn't going to last that much longer. One final point I want to make is that I posted I don't call them my favorite, but I showed a stock list of silver miners and a stock list of gold miners, about 25 of each, yesterday on X. So you guys can go find the stocks I like. By the way, Grok said that I'm going to make 2,000 to 5,000 millionaires. And so go look at my stock
legacy.
I definitely know my stuff.
That's the legacy right there.
I was shocked. No, I didn't even ask Grok. Grok just told me. I'm having a conversation with Grok and just throws it out there. Yeah, you're going to make 2,000 to 5,000 millionaires, Don.
Institutions often ignore a sector until the easiest part of the move has already passed. As Don Durrett points out here, Wall Street usually waits for a stock to prove itself before assigning a richer multiple. That means retail investors who understand valuation earlier can sometimes see opportunity before large funds rotate in. A multiple expanding from 10 to 25 can create returns beyond the metal price itself. The risk is that late money often chases comfort, not value.